Okay, hi everyone. Welcome to today's webinar. Today's session, we are going to be talking about the smart money concept, trading strategy. So let's just go ahead and get right into it. So as per usual, a risk warning and disclaimer, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, so you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and the risk tolerance have not been considered. IronFX is not responsible for any loss, including from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We are going to do a brief intro to SMC, and then ICT, because SMC is a kind of an extension to ICT. So we'll do a brief intro to that. And then we'll look at order blocks, breaker blocks, fair value gaps, and how exactly to use SMC in your trading. Okay, so if you guys have any questions throughout the webinar, feel free to pop them into the chat. Um, yeah, and let's go ahead and get started. So what is SMC firstly? So smart money concept is basically a way of trading that focuses on what the bigger players in the market are doing. So it was, like I mentioned earlier, initially popularized by an infamous trader who's also the founder of the ICT or inner circle trading, which is claimed to be the evolved version of the SMC. So SMC helps us to see where these big players are investing in. And the reason why is because these big players, which are often called the smart money, these include large institutions like your banks and your hedge funds who have a lot of money and can a lot of money and power to influence the markets. So SMC helps us to see where these big players are buying and selling so we can follow their lead and make better trading decisions. So the core concept involves replicating the trading behavior of these influential entities with a specific focus on variables such as supply, demand dynamics, and the structural aspects of the market. So now let's talk a bit about ICT and what we mean by it. So inner circle trading, which was originally created by Michael Huddleston to trade the Forex market, uses the same strategies to profit in all and any market that they trade, focuses on understanding the inner workings of the financial markets. So it involves analyzing market dynamics. So you can see it's pretty similar to SMC, analyzing market dynamics, supply and demand zones, utilizing price action analysis. Yeah, so pretty similar to what we saw earlier with SMC. So why is it important for us to understand ICT first? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate in terms of the chart technical analysis, um, your price movements, support and resistance levels, order blocks, so on and so forth. These can help us to understand how the markets operate and can give us a significant edge as traders. So by mastering the ICT techniques, you can then enhance your ability to identify high probability trading opportunities and effectively manage your risk. Okay, so what smart money looks like in price action of terms which replace support and resistance, reversals, and volume. So some key components of SMC would be your order block, which is your supply and demand. We'll give you some examples of all of these in a little bit. Yeah, so the order block, which is your supply and demand, you have your breaker or mitigation blocks, which this is what is traditionally called your supply, support and resistance. And then your mitigation block flips zones. We're not going to touch on that too much today. And the FVG, which is your fair value gaps. So we'll go through some of these in a bit. These are basically imbalances in the market. So basically when demand outpaces your supply or vice versa. And lastly, we have your liquidity grabs. So similarly with ICT, the key concepts that they use are pretty similar as well. You can see we have the liquidity, displacement, market structure shift, inducement, fair value gap, again, optimal trade entry, and order block. So you can see there's a lot of similarities between your SMC and your ICT. Okay, so let's firstly go through the key concepts in ICT, because I find that it is a little bit more structured compared to your SMC, which kind of just focuses on following the big players in the market. You know, these are more, I guess, things that you can actually work on and understand from ICT. So firstly, we have liquidity. There are two sides of liquidity. So there's the buy side and sell side, and secondly, there is the buy side liquidity. So where short sellers will have their stops position, your sell side liquidity is just the opposite. So buy side liquidity represents a level on the chart where your short sellers have their position, their stops positioned. Sell side liquidity will just be the opposite. Okay, so let me show you an example here. Okay, so you can see your buy side liquidity is basically the area where there are two swing highs. Sell side liquidity will just be where there are two swing lows. Now, smart money players will understand the nature of this concept of liquidity, and they will accumulate or distribute positions near levels where many stops reside. But what I mean by that is where there are many swing highs or swing lows, basically. So, the amount of stops at that key level then allows a larger player to fully realize their position. Once the level at which many stops are placed has been traded through, it's often that the price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme, like we see here. Okay. Now liquidity pool manipulation, it basically refers to areas on the price chart where significant clusters of buy or sell orders are located. These liquidity pools act as markets for price as they represent zones of substantial market interest. So these zones, I guess similar to what we've been using as our confluence areas, but these, in this case, we are talking about buy or sell orders that have um, areas where there are many buy or sell orders. So by identifying these liquidity pools and understanding their significance, you can then anticipate potential price movements and position yourself accordingly. Okay, the next concept is displacement. So displacement is a pretty powerful move in price action that results in strong selling or buying pressure. So generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have a large real body and very short wicks, suggesting very little disagreement between the buyers and sellers. So often a displacement will occur just after a liquidity level, like we see here, after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. Okay, we'll get into what those are in a little bit as well. So you can see here the displacement levels that we've highlighted come just after these swing highs and swing lows, which you can see previously we did mention as our liquidity areas. So now let's talk a bit about market structure shifts. So the main concept with regards to market structure is just the overall trend. So if it's an uptrend, obviously the price is making higher highs and higher lows. If it is a downtrend, the price is making lower highs and lower lows. Okay, so here's an example. You can see in this example, we have our swing highs and swing lows that I've highlighted in this example. So this is just pretty much an example for your uptrend and your downtrend. Okay, here's a very obvious market structure shift. And here you can see we also are using a um trend line, a descending trend line, which basically means that there are at least three touches on this trend line to show us that there is a descending, or rather a downtrend with regards to the market structure. So pretty straightforward for this concept. Now let's talk about inducement. So inducement basically involves the price bounce or a rejection in which price will then target a previous short-term high or low before continuing in the same direction as the longer-term trend. So it's specifically, so here in the example, we're talking about how a price rarely moves in a straight line. So within a larger trend, there's always counter-trend moves. These counter-trend moves are always the results of lower time frame liquidity hunting. So inducement is specifically targeting these short-term highs or lows as areas where these stops might be placed. Okay, so you can see here, our market structure shift starts about here. Okay, when price breaks below this swing low here. So we can see this downtrend start. Okay, so there's an uptrend once there is a recognizable switch in the shift of the market structure that's giving us our market structure shift, which starts about here. The inducement starts when there is a swing high, short-term high rather, not really swing high, that then reverses off and hits to create kind of like this kind of shape, like price is dropping or there is a rejection of this area that we see. Okay, so in these areas, we can expect to place our stops right after the inducement areas. Now let's look at fair value gaps. So these are gaps in the price chart where there is a sudden jump between two price levels, often because of a big move. So these gaps can be like unfilled areas on a map, and the market doesn't like these gaps, and prices often return to fill them. Spotting these gaps can help us to predict whether price might retrace or go back to. So, yeah, here our example is that it's created within this displacement and are defined as instances in which there are inefficiencies or imbalances in the market. These imbalances are visualized on the chart by a three-candle sequence containing one large middle candle whose bordering candles' upper and lower wicks do not overlap. Now, I'll show you what we mean here. So this is an example of a fair value, which basically describes an imbalance in the market. So you can see from our first example here, I guess, um, the price kind of departs from a specific level with limited trading activity over here. So it results in a one-directional price movement. You can see this uptrend forming. So here we have an uptrend, but in the case of a bearish trend, the FVG would represent the price range between the low of the previous candle and the high of the following candle. So basically the opposite of this. So this area would reveal kind of a discrepancy in the market, which may indicate a potential trading opportunity. Okay. So yeah, here's an example of a bearish trend. Okay, so you can see after price reaches the liquidity level, which is basically your swing highs or your swing lows, and then it reverses off of it, it then becomes a displacement. So then the fair value gaps are created within this displacement, and are defined as what we talked about earlier, the gaps in the market or inefficiencies in the market. So earlier I did mention about the three candle sequence. So you can see here that there Um, Often it is visualized by on the chart by a three candle sequence containing one larger middle candle whose bordering candles upper and lower wicks do not match up, or they don't overlap. Okay. Okay, so those are the key concepts for our ICT. So if we go back to our SMC trading strategy, it's pretty similar in terms of the concepts. I think they pretty much just use different names. So here, introducing break of structure. Um, this happens when the price moves past a significant level on the chart. So it breaks through a previous high or previous low. And this indicates that the current price is, or the current trend is continuing. So, okay, maybe in this example, you can think of it like if the price has been moving upwards, or yeah, in this case, you can see a slight uptrend. If we look at the first breakup structure, there's a very slight upward movement. So if the price has been moving upwards, it breaks above this previous high, which is this high here. It shows that buyers are still in control and the upward trend is likely to continue, right? So this breakout structure shows that it's going to continue upwards. If we look at this downtrend here, price is this is the swing, kind of the swing low. So there from this swing low, price broke below this level. So we are expecting prices to um continue to break below this level. It's pretty straightforward once you kind of understand it. So basically, if the price is moving downwards, like it is here, price breaks below the previous low, which is here, shows that sellers are still in control and that the downward trend is to continue, which is what we see here. Okay, now these are often used together with our change of character. Um, Again, both of these concepts are pretty similar to some of the ICT concepts that we mentioned earlier, but it's just kind of a different name for SMC. So change of character occurs when the market shifts from one trend to another, indicating a potential trend reversal. So it's like a signal that the market's behavior is changing. So, for instance, if the market has been in an uptrend and it starts making lower highs and lower lows, it suggests that the trend might be reversing to a downtrend. So, the opposite is also true. If a downtrend starts making higher highs and lower lows, it might be reversing to an uptrend. So, here you can see the first example, price breaks above this higher high. So, we're expecting it to continue in an uptrend. Here we see a potential trend reversal in which there is a swing low here, price breaks below it, so we're expecting it to become a downtrend. So the reason why you can kind of see why we use change of character with breakup structure, but I'll show you here. Um, okay, it's kind of I use the same image. But okay, if we refer back to our breakup structure here, okay. So this is our breakup structure. So, but to be able to identify where our breakup structure would be here, right? You can kind of see it would be at this level here. Okay. And if we were to look for another breakup structure, it would be, as we mentioned earlier, from a swing high. As long as price breaks above that higher level, that previous high, that would be here, right? So there's a breakup structure here. Okay, but if we look at another breakup structure, probably be this swing low. Price breaks below this previous low. So this is another breakup structure here. Let's see if there are any other um BOS that we can identify by, I think probably here as well. Okay, when there is a swing high here and price actually breaks out of this swing high level. So that's also a breakout structure. Okay. Um, are there any questions so far? I would draw it in, but there's something wrong with the pen on my computer, so I won't be able to draw on the screen. But basically, to reiterate, your breakout structure for this chart would be here, since price is breaking above the previous high. Um, the last one would be here, since price is breaking above this level. And I think there's one more that we identified was over here. So swing low, price breaks below this level. Okay. Yeah, so I'll get into the entry and exit points in a little bit. But yeah, let's just continue. Yep, you can use it with other indicators as well. In fact, we actually do encourage you to use all of the strategies in combination with other indicators so that you kind of get an idea of whether your analysis is correct or wrong. Um, you know, normally we would have about 4 to 5 indicators that we know how to use, are comfortable using, and then after your technical analysis, then we use our indicators to confirm our analysis. Okay, so let's talk about order blocks, and this is similar to, I think, somebody's question about entry and exit zones. So, basically what an order block is it signifies a concentrated area of limit orders awaiting execution. So these are basically the levels where we discuss supply and demands. So I guess it's kind of similar to your support and resistance levels and how to identify them, which we will get into in a little bit. But basically, an order block is identified on a chart by analyzing past price movements for significant shifts. So these zones serve as a pivotal point in price action trading, influencing the market's future direction. And when a multitude of buy or sell orders cluster at a specific price level, it establishes a robust support or resistance capable of absorbing pressure and triggering price reversals or consolidation. So now let's talk a little bit about support and resistance and how to identify levels to entry or for entry or exit. Um, okay, we would normally use support and resistance levels, significant levels for your pivot points, which would be your entry points. Okay, so these obviously refer to a level at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So it is basically important for you to identify these levels. You can use it using technical analysis tools like your trend lines, moving averages, chart patterns, and your swing highs and lows like I've done over here. So you can see what we call as swing highs and lows. In our previous examples, you can see that how we use that in your SMC as well. So this is pretty much just basics that allow you to expand to other trading concepts. So picking a starting point, so you want to make sure that you pull it back as far as possible so that you can see how significant these levels are. Okay, so you can see here where the green thumb is, this is a swing high, but where our orange thumbs are, it's kind of it's an all right level. But it's not great because it's not a significant enough swing high or swing low, and there isn't really um it cuts a bit too many bodies of the candlesticks. So for example here, you can see where the red thumb is cutting too many candlesticks. It's not you want to make sure that you have a really clean cut, something like this. Okay, some more examples here, clean cuts. This is a bit too messy. So we would just stop our entry level from over here. Okay, now the pullback and overlap concept is very similar to your SMC concept as well, where we talked about price overlapping or surpassing the previous high. So for pullback support, it's a strong level of support where it breaks out from the previous resistance level and price is now dropping back to visit it again. So when the pullback support lines up with a Fibonacci level, it is very powerful. So we'll talk a bit about Fibonacci at the end as well, because this also touched back on a SMC concept on maybe yeah. So I'll just say for your SMC the entry actually they encourage you to enter at the 61.8% Fibonacci level. So it's good if you can have a Fibonacci level that lines up with one of these support or resistance levels so that you have a really strong level of support or resistance. Okay. Um, yeah, so here's an example. You can see at the red area, we have price testing this level 3 times with multiple swing highs in line with that level. Once price breaks out of the red area, it becomes a pullback support, and we expect price to pull back or retrace to this level from the dotted arrows. A pullback resistance would be when there are 3 swing lows or 1 swing low even, and price breaks below that support level. Once it breaks below the support level, it then becomes a resistance because we're expecting price to retrace off that level. So this is what it'll look like on an actual chart. So we have a swing low here. Price surpasses our swing low support, then now becoming a pullback resistance, and you can see price pulling back to that level. And we're using this in combination with our Ichimoku indicator, because like I mentioned earlier, we want to make sure that we use as many indicators as we can that support our analysis. Okay, so we can see price kind of bouncing off of the Ichimoku cloud. So that in combination with this pullback resistance level shows that we might be seeing price bounce off of this level subsequently. So once price reaches this level and reverses off of it, it then becomes an overlap resistance level. So an overlap level is when the bulls and bears respect that area. So it's an important level to take note of. You can see in this GIF, it basically occurs when price touches from the top and from the bottom. Okay, so it shows that prices respect this particular area, and the more times that it reacts off this area, the stronger the overlap area. Okay, so again, if the overlap area lines up with other graphical elements, such as your Fibonacci or your graphical elements, it will make it even stronger. Okay, so swing low support becomes a pullback resistance here once price breaks the support at 105.643 in this example. So here we can see how price retraced or pulled back to this resistance level and reversed off of it, making it now an overlap resistance. Okay. Okay, so now let's combine both of these levels so that we have really strong resistance and support levels, which can also be used as your entry levels, take profit levels, so on and so forth. Okay, so in this example, we have a big swing high resistance level. Price surpasses this level and becomes a pullback support where we expect price to um, pull back or retrace this level and it bounced off of it perfectly over here. So we're expecting it to pull back to this level here. So price has made a pullback to our pullback support level and has bounced off of it perfectly. And once price bounces off the pullback support, it then becomes an overlap support. Okay, another example, we have two swing highs that line up, the purple circles. Okay, and price has surpassed this level and has become a pullback support. So we can expect price to retrace to this level. Take note of the blue circles. Here, price bounces off this level twice, making it a strong overlap support. Okay, last example for pullback and overlap levels. So here there are multiple swing lows that are in line at the 33420 support level. Once price breaks below that level, it becomes a pullback resistance at point number 2. Number 3, price has pulled back to our resistance and has reversed off of it 3 times. So since price has tested this level 3 times, it makes it a strong overlap resistance level. And then it happens again where price pulls back above that resistance level. So it becomes a pullback support and then it retests our support level, making it an overlap support. So pretty straightforward. If you are able to identify these kind of levels where there are many times where price tests that level, that's a good sign that it's a significant level to take note of as an entry point or a take profit level. But if you can combine those levels with your indicators like pivot points, Ichimoku, or even with your Fibonacci levels, that would be even better. Okay, so now let's go back to our SMC concepts. Okay, actually these are ICT concepts. Okay, we firstly have the optimal trade entry, which represent the best places to get into a trade. So according to ICT and SMC, the best places to get into a trade or your entry levels are utilizing the Fibonacci between 61.8 and 78.6. So I'll show you how to use your Fibonacci levels in a little bit in case you are unfamiliar. And another key concept is balanced price range or imbalance, which is the result of an aggressive move up that's immediately followed by an aggressive move down. Okay, or the other way around, where an aggressive move down is immediately followed by an aggressive move up. So what's left after either of these instances is essentially a double fair value gap, which we talked about earlier, and can act as a magnet to the price before a continuation moves higher or lower. And balanced price ranges can sometimes signal the beginning of a market structure shift, which again we talked about earlier, and the price can often retest and reject from these areas. Okay. Now let's briefly talk about Fibonacci and how to use it in order to enter at your 61 and your 78. Okay, so here's a very simple Fibonacci retracement checklist that you can use. So firstly, we want to check is the market structure clear? So a way to identify this clear market structure is by looking for big zigzags. Number 2, you want to identify the recent trend. So is price going up or down? Number three, identify the recent major swing lows and recent major swing highs. And number four, to connect the two extreme points. So the highest to lowest would be for a downtrend and lowest to highest would be for an uptrend. Okay, so here's an example on the charts. So you want to make sure that you follow the price structure closely, which is why I'm taking it from here to here. And here you can see my 61.8 lines up with this area. And you can see price bounced off that level perfectly. So this would be a good area for you to enter over here, especially according to our ICT, where your entry levels are 61.8 and 78.6. So another level here, but this time we're using 38.2. You can see how this 38.2 is also in line with a previous swing high and actually a swing low here as well. So this is what we mean by combining um, overlap levels or your pullback levels together with your Fibonacci. So we firstly will identify this is a swing high, swing low, which means it's an overlap level. But this overlap level also lines up with a 38.2 with the lowest point, the starting point here, ending point here. And therefore we can identify that price is likely to rebound off of this level again. Okay, which is exactly what happened here. Okay, in this example, we have two Fibonacci retracements that are being used. So the first one is our big Fibonacci retracement. So price reverses off the 61.8 over here, the swing high. Okay, and we actually have another swing high in that same area. So we have a double swing high as well as a 61.8, which makes it a significant level. Next, we have another retracement, a smaller retracement with the starting point here and ending point here. This time again 61.8, and we have two Fibonacci, or rather two swing lows that line up with this Fibonacci level. So we can expect price to rebound off this level and hit towards this area here where the double swing high was before. And also in line with our 61.8. Okay, I think that's pretty much it. If you are unfamiliar with Fibonacci, this is obviously just a small part of it. We are just going through really the basics of Fibonacci retracement. For ICT as well as SMC, you are mainly looking at the Fibonacci retracements. Okay, just as your entry because of the 61.8 and the 78.6 that they recommend. But there are four different Fibonacci techniques that we like to use. So if you've missed our Fibonacci webinar, stay tuned because we'll probably do those again soon. But basically, in the meantime, you can look up this website. It's just the forexarmy.com. We have a bunch of trading guides as well that are completely free for you to use. Um, Today I'm using this one. Okay, how to draw Fibonacci retracement correctly. We have some free YouTube videos for you to take a look at as well. What to look out for, some guidelines, how to identify a clear market structure. Um, but the most important would probably be these on how to identify your confluence areas. So confluence areas are basically areas where two or more Fibonacci levels line up together to create um this area, this Fibonacci confluence area as we call it. Reason being, these confluence areas tend to attract price really strongly, and price might not be able to push past that level. So we might see a price reversal off of those levels. So that's why it's important for us to be able to identify them. Okay, so we have some trade management techniques as well that you can check out. I'll just pop this website into the chat if you're curious as well. Okay, yeah. Again, it's completely free to use. yeah, this just for Fibonacci's, the different Fibonacci techniques, because I don't have time to go through all of them today. Okay, so I'm only talking about the one that is recommended by your SMC, which would be these, the retracement. Okay, so super basic, taking your retracement, your Fibonacci tool from the highest point to the lowest point. Um, yeah, and then seeing where the levels line up or where prices have in the recent past reversed off of those levels or have tested those levels. Okay, pretty straightforward. Okay, so how to use SMC in trading. So, it's all about being able to spot these key areas on the chart and making decisions based off what we see. So here's just a simple plan that you can use. Firstly would be to identify order blocks. So you want to look for areas where the price consolidates, which means move sideways before a big move up or down. And these are your potential order blocks. Next, you want to watch for breaker blocks. So you want to notice if the price returns to an order block and breaks through it, indicating a new trend direction. Number three, you want to find fair value gaps. Look for sudden jumps in the price market or the price chart, which can indicate where the price might come back to. And number four, plan your trades. So you want to use these areas to decide where to enter or exit a trade. For example, you might enter a buy trade at an order block or set a sell target at a fair value gap. And number five, combine with your other tools, like your other indicators and analysis methods to confirm your decisions and manage your risk effectively. Okay, so what time frame should you use SMC? Um, so the choice of time frame for SMC is completely up to you as a trader and based on your goals and your own strategy. So SMC recommends short-term traders to trade on a 1 hour to 4 hour chart for quicker insights, while longer-term traders might opt for daily or weekly charts to capture broader market trends influenced by institutional movements. Okay, that's pretty much it for today. Yeah, let me know if you guys have any other questions about SMC or your Fibonacci. If not, that's pretty much it from me for today. Yeah, but yeah, I'll stick around for a while in case you guys have any other questions. There are a lot of websites out there as well, on how to use your smart money concept, um, or your ICT, inner circle trading. So feel free to just Google it and check out the websites online as well. I'll stick around for a while in case you guys have any questions, but if not, you guys can go ahead and leave. Oh, we can't share the slides, but this webinar is being recorded, so I think the recording might be available. Um, yeah, feel free to just email IronFX as well. They should be able to help. If you just email them and ask for the recording, they will be able to help you out. I'm not able to send the slides on on your email, so you have to email them. Let me see. Let me see if there's an email I can find. Yeah, I think I'm just gonna pop it into the chat. Yeah, so you can just ask them for the recordings and they'll be happy to send it over to you guys. Okay, if there are no other questions, yeah, that's it for today. Thank you guys so much for joining me. I hope you guys found this session helpful. If you guys like me, feel free to add me on LinkedIn as well. It's just my name. It's just Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye.